Hello and welcome to everyone. Thank you so much for joining us on this Wednesday, the end of July. As you know, the Fed met today. So, right hot off the presses, Casey is going to be talking about some trends, some things that you can do to prepare yourself and your business to be successful going into this third quarter. Um, and I just want to say a special shout out to all of you that are joining us. You know, those of you that are here today, we can tell that you are the successful realtors in our industry because you are here to learn and you want to grow and you want to know more. So thank you so much for joining us. Without further ado, I would like to go ahead and introduce my amazing husband, Casey Sullivan. He's going to take us through what we can expect going forward. So thank you so much for joining us.
Hello, thank you. So, we'll jump right in since I've got 30 minutes to give you as much information as I can to help you for this next quarter and for the end of the year. So we always do love your feedback. Partially through the webinar, a little survey is going to pop up. We love any sort of input you can give. There will be a recording. So if there's something you heard and you wanted to hear it again, or a screen you wanted to see, it will go out to you after the recording, after the webinar is over. There is a little chat box up on the top right. Feel free to, have at it and chat, and one of us will chat back with you. And they are public, so don't be surprised if other people see it. So let's kind of jump into a little bit about who we are. I'm going to go fast over this since a lot of you already know us. But CrossCountry Mortgage is the company I run a branch for here in Walnut Creek. We are the #1 retail lender in America right now, #1 portfolio or non-QM lender. So we're not small. We just don't advertise at the Super Bowl, so not everybody knows about us. My team that I run is myself. My wife, Nikki, who was just doing the introduction, she does our business development and realtor support. We've got a Nicole Garcia, not to be confused with my wife, Nikki. She's our ops manager, does a lot of the pre-approvals, make sure we execute on dates on contracts. We've got Teresa, she's our pre-approval specialist. We've got Melissa, who's our marketing coordinator. And then like any branch in mortgage, we have, the processors and the underwriters and other loan officers. We are set up in all 50 states plus Puerto Rico. And if you have any friends out there that are looking either on the sales side of lending, if they're a loan officer or a production or customer support person, we're always hiring. So send them our way. Let's jump into this. So main topics, we're going to talk about last quarter, current quarter, some wins for for this current quarter, some trends and some tools. So the last quarter recap, well, rates held steady in the high range. So they were pretty stable throughout most of the quarter. We had a little variation, but they kind of fluctuated between 6.6 and 7.08. Specifically, if you're looking at the screen, you'll see the chart. There was a little dip at the beginning of the quarter, but then it just kind of held pretty firm there. So the buyers had always hoped for significant drops, but it was really more of a higher for longer environment, and that kind of began to settle in on buyers' appetite there. Now the current quarter, we've got, the thought is, and I don't want to say that rates won't drop, because I would love to see that as well, but I think we have to go in thinking mortgage rates are going to hold steady with just some modest fluctuations. So Q3 rates are projected to stay in the mid to high sixes where they are now. Well, it's not ideal, but it's definitely become the new norm. Cuts from the Fed might not drop mortgage rates meaningfully even, because there is some longer term risk of the national debt and inflation. Now, the Fed did talk today. This little cartoon says, no rate cuts. So that's what we heard from the Fed. And you can only imagine Trump's response. He did post on social media this morning before the Fed rate cut. He said, I'm going to read this, Q2 GDP just out, 3%, way better than expected. Too late, which is his name for pal, Mr. Too Late. Too late must now lower the rate. No inflation. Let people buy and refinance their homes. So that was his comments before the Fed met, or before the Fed had their announcement. So right before we jumped on, I was listening to the press conference. The Fed made no rate change. He was in the middle of his press conference and somebody asked him about September rate cuts. He wouldn't answer it. There were, oddly enough, 2 dissenting votes by voting members this time. We haven't seen 2 dissenting votes since kind of the Reagan era. So meaning 2 of the voting members of the Fed disagreed with the no rate cut. So that's a start. But if you looked at what the Fed put out there, there was no major change in their verbiage of what they believe. So we're just kind of stuck in this holding pattern. And I was showing that rates as of today, kind of national average was 6.75. So that's where we stand. So the Fed didn't help us today, maybe someday in the future. So where do we think rates are heading? If we look at some of the organizations, Fannie thinks we'll be at 6.5 by the end of the year, but they did increase that up from 6.2. Mortgage Banking Association thinks 6.7 average through year end. NAR thinks 6.5 by end of 2025, but they expect the higher for longer to hold. National Home Builders Association, they think 6.0. Now they're very aggressive there. They had initially projected 5.8, so they have increased it since their last projection. So they're on the low end there. But basically all major forecasters agree that they'll stay in the 6s. So the thought on smart buyers and smart agents and smart lenders is we're just going to have to adjust and act when it's appropriate and not wait for lower rates. So how can mortgage rates, I get this question a lot. So if the Fed holds rates or changes rates, how can mortgage rates change? Well, there's something called the mortgage spread. It's not talked about a lot, but it's good to understand a little bit. The mortgage spread is the difference between the 30-year fixed rate that we all talk about and the 10-year treasury yield. And so at times when there's more volatility, the spread gets larger, meaning you take the 10-year treasury and you have to add more to the 10-year treasury to get to where the mortgage mortgage market is. Right now we're at it was 2.35 when I created the PowerPoint. Today it's at 2.38. So you take the 10-year treasury, you add 2.38 to it, and that's where you get to that 6.75. Now, the peak of the spreads was kind of during 2023, where it was a little over 3%. So we're seeing it start to come back. And what we could find is if we can get it back to normal spreads, which is 1.5 to 1.8, even without the Fed cutting rates, it could drop mortgages down to about 6.25. So again, this is if the Fed doesn't do anything, but the market in general responds better to yields and to the spread, we could see lower rates. So we don't need a rate cut. However, a rate cut would not be a bad thing to get. So that's mortgage spreads. Kind of what today would bring is what we see on consumer outlook right now is there's still some uncertainty. Not all clients are uncertain, obviously, because people are still buying and selling, but there is this slowly regaining confidence. People are watching interest rates, are watching inflation. Affordability is a big topic. We have a new tax bill, which I'm going to go over in a little bit that maybe will help in certain areas. But what we're really finding and what we predict for this quarter is the increase of creative loan structures really being the keys to closing deals. So I would expect, and what I'm already seeing, and it's only, the end of July, is increased use of things like temporary buy downs, non-QM programs. These non-QM programs are expanding buyer eligibility, and some sellers paying closing costs in order to preserve the affordability and help the buyers get into contract. So we're starting to see more of that than we do in a more intense market. So like when I think about the types of buyers, like a first-time buyer, they're always thinking about affordability. So on that, we're thinking about, different buy downs, different PMI, handling mortgage insurance differently. If they don't have the cash, looking at some of the down payment assistance programs. When we have our buyers that are self-employed, usually the thinking they're having right now is, I know I make the money, but how can I prove it? Meaning their taxes don't show what they need. So on those, we're looking at those more creative loan structures, bank statement loans, maybe asset qualification. And then you have that group of buyers. I've got them in my list of pre-approved buyers who are just what we call fatigued. And they're just thinking, is now even worth it? So really on that side, what I do and what I think realtors are probably doing is more of an emotional re-engagement. And then maybe talking about flexible products. So maybe that temporary buy down will get them back engaged with this market. The move up buyers, what I hear the most is, I don't want to lose my 3% rate. I don't want to lose my 2.5% rate. So with those, we spend a lot of time on, okay, well, do you want to keep it as an investment? And then how do we help you buy a house, maybe a bridge loan? Maybe they do end up selling their house, but how do they buy before they sell? So we spend time on that. And then lastly, on the investor, it's the thought is, does it even cash flow at, current interest rates? And there we talk more about kind of some creative ways of doing it, some of the investor cash flow loans. So that's what we've got there on that. Now, what is driving behavior? I see people being very cautious and selective, waiting for the right house. They don't want to overextend themselves. I'm getting more and more questions about, gosh, this payment seems high, compared to my income. So we're spending more time on the financial counseling and coaching. A lot more focus on what's my payment, more than what can I qualify for. So it used to be like, hey, what do I qualify for? And now I see more and more questions talking about payment. So with our first time home buyers, I think really the target for us is to help them, find a way to help them compete with strong lender support, and really showing them the costs and the monthly payments, and maybe talking about those temporary buy downs. For our self-employed buyers, really seeking flexibility now that we're past the tax season for most of them. So this is where we're talking a lot about bank statement loans and P&L loans. Like a lot of self-employed buyers, especially on the smaller side, they just don't fit the box, and we really have to show them that there's a better way. So I'm sure you've all had, the comments from some of your buyers who say, I tried to get approved, and, because I'm self-employed, it just isn't going to work with taxes. So really on those cases, they really have to talk to a non-bank to learn about the different lending options that could serve them. And then investors, in some of our markets, we have, good investor properties. Some we don't. Sometimes they're buying out of the area or even out of the state. But really, investors are focusing on cash flow, not just the appreciation. So the most common loan that we're using is called a DSCR loan. And this is where they qualify off the rent of the property as opposed to their own income. So they might not have a job, but the property itself cash flows. So therefore, we'll do the loan. So we're finding they're kind of strategic on purchases there. But, when we're working with our investors, I think the best kind of mindset is to have a pitch around the ROI on the property, and also reminding them that we don't need tax returns. So really the takeaway is, you can win more buyers by understanding what's holding them back, and then helping offer them some smart loan strategies to move them forward. So again, kind of that first time home buyer, kind of payments, maybe down payments. Self-employed buyers, it's helping them qualify without their taxes, and investors, it's really looking into the return on investment. And I do see a question, I'm going to jump to it, about Chairman Powell's term ending in 8 months. I fully expect that he'll be replaced by a new chairperson that will drop rates pretty quickly. I think they'll still have to kind of keep in mind how, inflation is doing in the jobs report. But right now, most people believe that the interest rates the Fed are publishing are still restrictive to some degree. So I think getting back to a neutral rate is going to be their first start. We know the president wants, I don't know, I've heard 2% rate cuts, some big numbers. They're still going to have to look at it from their position in the Fed, but I think you're going to see some larger cuts there. How mortgage rates will respond will be interesting, because they respond to kind of what the Fed is talking about, but they're also responding to that, the 10-year Treasury and the spread. So kind of what the risk tolerance is for mortgages. So it can't, I sure don't see a way that it can help us if we get a new Fed chair in there that's a little bit more responsive to the needs of real estate. Again, Trump was pretty clear today when he talked about Mr. Too Late, and when he ended his post, which was let people buy and refinance their homes with a lower rate. So I think he's pretty adamant on that. So that's what I would say, Mark. So there'll be a time that will come up. I think the issue will be as we get closer to that, like what is the messaging? Do we end up having buyers and sit on the sidelines waiting for the lower rates when we do have a new Fed? There's talk of the shadow Fed, like will they actually kind of appoint a new Fed chair before the old Fed chair is gone? And then people will start listening to the new one, and he or she will go out and give interviews. So that might be a good bridge in between both of them, so we know what's coming. Back onto like what the administration did is there was a new tax law, and what we saw, like the main things that I'm seeing for our clients is the biggest is the affordability boost. So there's the SALT deduction, which stands for state and local taxes. So in California, for example, your state taxes are probably more than what the old deduction was, which was $10,000. Now it's jumped up to $40,000. So in that $40,000, it allows you to write off your state taxes and your property taxes. So when the SALT deduction went in, when the cap went in at $10,000 in the past, what it was causing was it made it so that most people, including myself, couldn't write off my property taxes. Whereas for years, I was writing off my property taxes to the county. And so the SALT deduction bumps it up to 40, which will help. There's some on all of these. There's always some, fade outs with, certain income levels, and there's always some caveats there. So check with the tax person, but they did bump it up to $40,000. They also did something which was interesting is they made PMI tax deductible. So PMI has always been, something that people try to avoid. And part of the reason was you couldn't write it off, your taxes. Well, now it is deductible. So that will make a whole different game. So those are two great reasons to reach out to either maybe your clients had already bought to tell them about like what they can do with the next purchase, or maybe, buyer leads that had yet to convert, because these are big changes to affordability. And then the new tax bill also made the mortgage interest deduction permanent. The bill that was, the current tax bill before this, it was not a permanent part of the tax code. Now it is permanent. So that has taken away some fears on that. Now with housing and legacy, they did take the estate and gift exemption and they bumped it up to 15 million, give or take, for next year per person. So for those of you that, know people that have over $15 million in their estate and they pass, well, they're going to have to pay some taxes. Now, reminder, a lot of times there's gifts that are part of real estate transactions from family members on the loan. A lot of times people think that the most they can get from a family member is $19,000 a year. Well, remember that that's just per year, per person per year. But they can also, if they give 100,000 or 200,000, they can apply that towards that 15 million lifetime exemption. So the 19 is just, for per year, not counting towards the 15 million. So again, there are ways there to make parents feel comfortable with gifting early. Now for investors, there was some stuff done with expensing on commercial, some opportunity zones, some of the lower income housing credits were expanded. And what we see there is it could end up, helping create some new inventory in the markets. So that's not something we're talking to our buyers about much, but there was some interesting developments there. So the main one is the SALT deduction, and that PMI is now deductible. So feel free to share that with your clients. So what are some of the kind of deals, like creative financing, that we're finding is starting to work in our markets? Probably the one that comes up the most, and I've spoken about this before, it's the buy before you sell, the BBYS, buy before you sell. And what it obviously does is it eliminates the sale contingency. It prevents a double move. It fixes timing issues on a purchase and sale. And it really allows for a more efficient selling process, allowing you to prep the house, stage the house, market the house, and sell the house, as opposed to trying to sell it while they're still living there. Now, the most common kind of ways to think about the buy before you sell is the buyer short on funds? Meaning, do they have the down payment for the new house, or is it built into their current home? So if we have to tap the current home's equity, we're looking at things like second mortgages, home equity lines of credit, and bridge loans. We probably have 12 or 14 different ways to do these buy before you sell. So our job is to analyze the situation and come up with the right way. The other kind of common area on buy before you sell is for people that can't qualify to own two homes at the same time. So with those people, we have to look at flexible qualification options. We've got a great portfolio loan where I can ignore the payment on what will soon to be the old house. So I can ignore the principal, the interest, the taxes, and the insurance. That loan also allows me to add a HELOC or a bridge loan to that departing house, and I don't have to count that payment either. So again, I'm ignoring all the debt on the house that will eventually be sold. And then there's the cross-collateralized bridge loan that's quite popular, and that allows us to not worry about their qualification if they've got the right amount of equity. So really, again, how we come into play here is, you tell a client, hey, Casey's got, 12 to 14 different ways to do this, chat with them, and I'll kind of talk through it with them and see like what paths open up for them and what might be the cheapest for them. The advantage on this program is it's really a good talking points for move up buyers and even move down buyers. Most common, we had been using it for move up buyers, but now we've been seeing some more move down buyers. We're doing one for a lady right now who's moving to Oregon. She has a house in California and she's downsizing. And so we're using the bridge loan, the cross collateralized bridge loan, in order to help her make that move. At the end of the day, when she ends up selling her house in California, she will have no mortgage on the Oregon house. It will cover everything. Other times that's not always the case. But so again, it really works on the move up and the move down buyers. And it's really, the talking point is you don't have to wait to sell before you buy. And we all know if I tried to sell my house still living in it, what would I do with the dogs at each showing? So it really prevents a lot of that chaos that could happen if you're trying to sell it and write contingent offers. The next common one, we've all heard about it, I assume at this point, is the temporary buy down. It seems to have been resurrected recently, I think, just with how the market's been trending. But what a temporary buy down does is it lowers the buyer's interest rate for anywhere from 1 to 3 years. For example, the 2-1 buy down, which is what is commonly talked about, the rate is reduced by 2% for the first year and then 1% for the second year before settling in at the fixed rate. So let's say interest rates were 6.75 for the loan and they got a 2-1 buy down, they would go to 4.75 for the first year, 5.75 for the second year, and then it would revert to that 6.75 for the rest of the 30-year term. There's also other versions of it in case the seller doesn't want to pay that full 2-1 cost. There's the 1-1, which is 1% lower for year 1, 1% lower for year 2, and then it goes back up to what it should have been, or just the 1-0 buy down, which is the cheapest of all of them. And what it does is it lowers the interest rate by 1% for the first year only. So it's just a 1-year buy down. So these are all ways to help buyers get lower payments early on, like when they need it most, when they're getting settled, when they're getting adjusted to owning a house. It's definitely a great solution for any rate sensitive buyers who are sitting on the fence. And then it opens up an opportunity for them to refinance, hopefully in the next 1 to 3 years when rates drop. Not a guarantee, obviously, but it gives them that opportunity to kind of have hopefully tomorrow's rates today and then be able to refinance, when rates across the market drop. Now for the realtor advantage on it, it's really a great smart tool for listings that have been sitting around, and it can reignite some buyer interest. So instead of, if you've got a property that's sitting there and you're trying to decide, do you want to do a price reduction? How much should you reduce the price? Offering something like, the buy down, is usually cheaper and more cost effective in general versus a price reduction. So I call it sell like buyers do. Sell like builders do. So if you look at the new home building, which isn't huge in parts of the Bay Area, but across the nation, builders sell very differently, and they sell by these temporary buy downs. So at all of their homes, they've got flyers out there offering, 4.99, 4.5% interest rates for the first year. So they're always selling that way. So that's how they go about doing it. And the temporary buy down is really a win-win for both buyers and sellers without having to devalue the home by cutting the price to get enough interest. So that's a temporary buy down. What we have been offering right now, which is a unique offer for our VIP realtors, is we will either pay for the full buy down or we'll contribute with the seller contributing to get the buy down put together. Again, helping everyone sell like the builders do. So with the one that we pay for by ourselves, what it means is we'll cover the buy down. The seller won't have to, the buyer won't have to, and it allows you to market your listings more aggressively. We'll prepare a custom lender buy down flyer, and it will show what the buy down will be. It's something you could put at the open house. It will show a very attractive interest rate because of the buy down. It's also, you'll get some verbiage from us if you want to put it into MLS to help market the listings, to show other realtors what you're offering. And it should really differentiate yourself from your competition, especially if you're using it during your listing presentations and marketing, saying here's what your lender can offer to you in order to help move the property. And these buy down options that the lender, us, pay for, it works both on conforming and the larger jumbo loan amounts. It's just what sort of buy down will come from what the loan amount is. So it's really good for homes where market is just sitting longer than expected. Maybe it's good for a condo that isn't moving. You know, anything of kind of a fresh talking point that you might need. Maybe you run some online ads with it if you're trying to, you know, sell a property. So if you want more information on that, you know, definitely let's connect. If you're not already a VIP realtor, you know, let's connect on how we can build that relationship together. And you just send me a quick text message. My cell phone number is 925-789-0065, and happy to chat about the temporary buy down on the lender side. And the other kind of out of the box loan programs, we talked about bank statements. Again, that's huge for self-employed people. Can't tell you how many times we use it. So again, we just look at 12 months of their business bank statements is the most common option. We add up the deposits, that's their income. The investor cash flow. So again, this is where they're qualifying using the rental income from the property only. I don't care any other properties they own. I don't care what their job is. I just care that this property can cash flow. And that's what we're focusing on. Asset qualifier loans, these are for loans for your clients that have high net worth, but maybe don't have a great amount of income. This could be somebody who maybe sold some stocks, maybe is retired, is just sitting on cash, but not a lot of incoming income. Could also be for people relocating. Then there's the renovation loans or the fix and flip or fix and hold loans. So if you have clients who are out shopping for those types of properties, we definitely have loans that can work on properties that are rough or need to be ripped down and built again. And then the last one, which is kind of the nuclear option, which is called the no ratio loan. This is where we don't look at income or employment. It kind of reminds me of, you know, the olden days with subprime, but it's not. They need 20% down and they need to have some payment reserves, usually at 6 to 12 months of payment reserves. These are really good for people that maybe we just help somebody who is working for a startup in AI and they just aren't getting pay stubs. They're getting stock options, but no income. So this allowed them to still buy their house. Or for people who are maybe relocating and they're relocating to hopefully California and they just haven't found their job yet. And so this allows them to buy and then they can refinance once they have their new job. And let's see, kind of your edge in today's market. So let's assume rates aren't dropping. That's a good place for all of us to get our head around. And let's work with what we've got. Let's think about strategic financing will beat price cuts, and creative loan structures really can help strengthen our offers. Using non-traditional loan tools to solve problems is really going to be helpful in this market. And a plug for a good lender is a lender matters more than ever. You know, having the DMV lender, the big bank, the online lender only, you know, is okay, I guess. But, you know, when you have a more creative minded lender, you know, that's where deals can start to come together. And some tools and resources. Hello, Nikki, I see you in there. If you have any questions, you can always reach out. You know, my cell phone's in the chat. It's here on the screen. There's a little QR link. If you're watching this on a screen, you can scan it with your phone to book a time with us. Or to have your clients book a time. Other things we provide to our favorite realtors is we do happy hours where we network with other local professionals. We bring in CPAs, financial planners, insurance agents. Who else do we bring in? Attorneys, trust attorneys. We provide lots of education with webinars, both for buyers and for realtors. And we always have weekly communication with the deal is our weekly email. And I do send out a Thursday rate update. So tomorrow's rate update will obviously talk about the Fed and what the Fed did. So if you're not on any of these invites, shoot us a message as well, and we'll make sure we get you added to that. Thanks for joining. I don't know. Nikki, did you push the little survey out there for us?
I did. The survey went out at the temporary buy down. So hopefully everybody was able to take a look at that and click on it. Thank you so much for comments on what you think about this webinar. We put this together for you. So it's really important for us to understand if we are bringing you value, how we're bringing you value, and also give us some ideas on what you want to see from us. Together, we can, take care of this market and make some homes move. But yeah, that's it. So right on time here. It's 12:30. Hopefully Mark's question was answered. If Mark, you want to chat with Casey, I know you know how to get a hold of them. And also we're open to discussing strategies. So please feel free to reach out to us. And with that, guess we are done.
Yeah. Have a good day.
Okay. Thanks, everyone.
Bye.
Bye.